What's going on, everyone? And welcome to another weekly review. This week, I'll be going through the one trade I took. It was a pound JPY short. It was a loss. Took this on Friday during London session. And I think the key takeaways here are just expanding on some of the lessons. The main lesson that I was going through in my backtesting session on Thursday on the price delivery model. If you haven't checked out that backtesting session, be sure to do so. Lots of gems in there. Basically, walk you guys step by step through how I backtest, what how to select like a topic, the level of detail that you should probably go into, so that you can just get the most out of that backtesting session. And then it's basically my whole session backtesting Euro USD the first week of June. So maybe before I jump into that, the price delivery model, as ICT calls it, basically how price the various phases price transitions through as volume is delivered in the market. And while ICT calls it the price delivery model, for me, it makes more sense to coin it the volume delivery model, because while price is obviously price ranges during the day, and I understand that price changes, and we execute based on price. Volume almost determines price. And so for me, I think logically it just makes sense to refer to it as the volume delivery model, because it details how volume's distributed over the course of a session, a day, a week, a month. And those primary phases are obviously consolidation, expansion, and then retracement or reversal. And so what we had in this trade was clear consolidation, marked out the Asian high, Asian low, and then we had this expansion and then a reversal. I was then anticipating a retracement and then a continuation lower, just based off where we were on the high time frame. And then obviously executed this trade at this point here, near where the New York high was, and then consolidated throughout New York, and then got stopped out again just slightly after that New York open. So that was the trade, and I'll just take you through briefly now why I got that wrong. There was just a minor error that was made on the day. So this is my ASR, my advanced self-review. This is how I basically template my trades, and this almost allowed me to review my trades in detail, just to determine what went right, what went wrong, and to sort of extract any 1% tweaks that can help me improve my edge. So this was primarily started on the 4 hour time frame, the analysis. So there's nothing on the daily or the weekly. Price had shifted on the 4 hour, formed an order block, which we pulled back to, up into very correctively. And then once we got into that order block, we had confluently ran time-based liquidity, the daily high on the previous day. And then on the 15-minute time frame, we swept time-based liquidity again, those Asian highs, these Asian highs there. And then we broke structures to the downside. That was that reversal after the expansion. From a quarterly theory perspective, price had accumulated the entire week. Then on Friday, manipulated lower after the true open, post that time-based liquidity sweep, and then distributed to the upside. It's where I got the analysis slightly wrong. And then on the daily, London distribution was correct, but I anticipated that to play out for the remainder of the day, which was not correct. New York session manipulated lower and then distributed higher. And so coming back to the volume delivery model, what's key here is that we get a consolidation, we get an expansion, and then post expansion, it's either a retracement and then a continuation in the direction that price expanded in. So, for example, this was the expansion. We get a retracement and then a continuation in the direction of this retracement. or we get a reversal, which is then the expansion. What I interpreted incorrectly was getting the reversal, expecting a retracement, and then a continuation in the direction that we reversed in. But that, according to the model, just isn't correct. Post that reversal, which actually was our main distribution for the session, we then re-enter consolidation. And if the bias for the session was to continue lower, we would have seen that expansion to the upside and then the reversal lower. Um, Instead, we obviously got the expansion lower, which was the sweep of New York lows, and then we got the reversal to the upside. So that was a key sort of detail that almost led me to interpret this incorrectly. Is that what I anticipated after the reversal was a retracement and then continuation, which is not correct. It is consolidation, um, consolidation, expansion, retracement, then continuation, or reversal, which is our expansion. And then we go into consolidation again. And so just taking you through what the high time frame was, you can see this was our 4 hour. We obviously had this order block that I was referring to, sweep of those daily highs on Wednesday or Thursday, actually. Well, Monday, Tuesday, Wednesday. And then I interpreted this as the manipulation higher, whereas this was actually the manipulation lower on Friday. You can see a lot more volume here. But then obviously that was just the wick that was formed, and then we distributed to the upside. And then, 15-minute time frames. There was a market maker model that I had also interpreted there on the, because which time frame was it? Can't see it too clearly here, but there was also a confluent market maker model, but that didn't form part of the primary bias. And so when I look at, did this trade meet the plan? It did, but it wasn't a great trade. I think because the high time frame was in line. We were in an order block. We shifted on the minute 15. Obviously, then I was looking for that continuation lower. I would hesitate to take the position again. I think arguably because I missed the distribution in the session that I was trading. And so I was just late to the position. So not that I wouldn't take the trade again, but I would hesitate to take that exact entry. I'd initially said no, I wouldn't take the position again, just because I thought it was wrong. But after just further evaluation, it was not that the setup was wrong. It's just that volume had distributed over the session. The entry was late, and I definitely would take the setup again. But the entry model would need to be different. My psychology: neutral during entry, neutral during management. It met the plan. I was fairly conservative with my risk. I just realized when I got stopped out that I didn't expect to be stopped out. So that almost told me that I actually had an expectation of how this should be playing out, which was incorrect. Something to just take note of going forward. When I set the trade, you need to keep in mind that it could be a winner or a loser. What lessons can I learn from this position that will improve my edge? It's that biases can change over sessions, and I shouldn't expect the daily bias to be consistent over the primary two sessions of the day, London and New York. That goes back to continuously monitoring how the market's evolving over the day, and not thinking that whatever I forecasted in the morning is going to play out in the evening. Additional notes and thoughts with regards to the price delivery model, volume delivery model. A reversal is an expansion and does not always constitute a retracement and then continuation. That is the key takeaway, I think, from this week. And then other thoughts or questions that I had is, how do I enter on a reversal post-expansion as there is really a pullback? Meaning I need to look at how to enter these kinds of positions, obviously before this breakout takes place, somewhere above here. Look for signs that tell me that this is going to continue low, because there are cases when obviously it breaks lower, comes back, reverses, then continues lower. But there are a lot of times also where once this breaks the minute 15, it's just a high momentum sell off to the downside, or it breaks out higher and it's just gone and it never really retests. So whether that's in the form of inverted fair value gaps or monitoring candlestick formation or high time frame confluence, I need to look for entry models that can almost help me time those entries earlier so that I'm not missing these distributions to the downside. Because had I taken this up here, obviously with stops above here, could have been a decent 1:2, even potentially a 1:1, 1.5, down to those daily lows. And then the last thought was on an expansion and then retracement, where do I enter? Meaning, once this expanded up here, if the move was to retrace and then continue higher, what do I look for primarily as my point of reference or my point of interest to enter trades? Is that going to be a fair value gap that's created as we break higher or as we expand higher? Is it going to be the 50% level of the consolidation? I just need to be clear on what I'm going to look for depending on the scenario that's playing out or what price is communicating to me as that expansion occurs. Because obviously during the consolidation, we're building up liquidity. And then the expansion's the key sign that, okay, we've broken out. But after the expansion, obviously there's two possibilities. We either retracing and continuing or reversing. I need to be mindful of being able to enter on both. Obviously dependent on other factors like high time frames. So if it's minute 15, what my 4 hours doing. If it's minute 5, what my 1 hour is doing, and so on. And so yeah, that was the trade. Lots of lessons here. I think looking forward to continuing to monitor this. I think looking forward to those backtesting sessions because that's a intense sort of 1 hour session where I'm really developing my edge, which goes a long way towards just kind of sharpening the tool set on how I interpret the market, how I execute. And I hope you guys are taking your value away from that. And so don't forget, guys, consistency is the choice you make when you start doing the things you know you should be doing day in and day out.